The high yield that we're seeing here today is likely to stay. Interest rates are decided by the central banks, whereas yields are decided by the market force or the investors. And both interest rates and yields move in tandem like this. In today's tutorial, we will understand the difference between interest rates and yield, a healthy yield curve and an inverted one, and the risks and opportunities with a prolonged inverted yield that we're seeing here today. My name is Kon Hao. My work in this channel, as always, is to study into the correlation between the different markets and uncovering potential opportunities. And before we discuss today's topic, please do take some time to read into the disclaimer. Interest rates and yield, what are their difference? Interest rate is determined by the Fed. They are for the borrowers. For example, the housing and business loan, they may take reference from this Fed fund rate that's indicated in green. Whereas yields are for the investors or the lenders. So the US governments issue bills and bonds, and investor or the lenders look at the yields or what are their return on these bonds. Now let's look at the borrowers, who is the US government, where they issue all these bills, notes, and bonds. Anything between 1 month to 1 year is called the bills. Anything between 2 to 10 years are called the notes. And between 20 to 30 years are called the bonds. So now we have a good understanding. What are the relationship? So what are the difference between a healthy yield curve and an inverted one? All these years, since before 2022, we are experiencing generally a healthy yield curve. And that's what we're seeing here. It means that the 2 years tenure, the return for the investor who are the lenders, they will get a lesser return compared to the 30 years. Now, let me explain here is that, again, the US governments, they are the borrowers, investor are the lenders. So the US government promised that, say, for example, in the year 2010, that we can see here, that's the return. 2010, if you get into a 2 years tenure, the US government will pay an interest of 1%. But however, if you get a tenure into the 30 years tenure, who is a 30 years bonds, you will get a return of about 4.5% return. So it is reasonable because for investors who are the lenders, if I'm going to get into an agreement for 30 years, it's a long time, it's into the unknown. So I'm expecting to get a high return compared to the 2 years tenure. So I'm getting about 4.5. And where we can see here is that all this tenure between 2, 5, 10, 30 is in this manner. And this is what I call a healthy yield curve. And we could see that since over this whole period, since about the 80s to 2022, we have all these healthy yield curve. But something have changed, where indicated here as golden cross. In March 2022, if you still remember what happened to March 2022, it was the first time where the Fed increased the interest rate and everything started to turn for the last more than 1.5 years, that we can see that the whole relationship has inversed. The green line is the highest, followed by the red, followed by the orange, followed by the blue, and followed by the yellow. And let me just use a percentage mode that we can see much clearer, that we could see the Fed fund rate now is the highest, the 2 years tenure, and followed by the 5, 10, or the 30 years. And the 30 years is the lowest. And this is what I call an inverted yield curve. Let me just reverse this back again. An inverted yield curve is a good indicator for the coexistence of a recession and an inflation. And seems like it's going to stay this way for quite a while. It is also a sign of pessimism in the financial market. Now let's look at what happened to the '07 crisis, what I label as the almost an inverted yield curve, which is what I call that there's almost a golden cross but a failure. What do I mean by that? If you can see somewhere around 2007, The green line, who is the Fed fund rate, is almost surpassed all. It's almost inverted, but thankfully the central bank and the Congress came with some measure, and it was wonderful. And the yield curve almost inverted, but it went into a healthy yield curve again. And if you still can recall that in '07 and '08, the crisis was pretty short term, but because of the yield curve turned positive again, or a healthy yield curve, it kind of saved the whole stock market. And we saw a V-shaped recovery until today. And what we're looking at here is the Nasdaq. And let's look at what happened, and this will bring us to the third point here. What are the risks and opportunity with a prolonged inverted yield curve since March 2022? And we've never seen this before over the last 40 years, but it has been more than 1.5 years. It was inverted, and it is still inverted. Now, the risk is that I will have lesser of stock holding for the long term. And the opportunity is that I'm definitely into commodities, like all these commodities. Maybe I'll get into their funds or stocks, and also buying into or hedging or trading into the yield. Since the yields, the interest rate are moving higher, I'll be definitely interested in all these 2 years, 10-year, 5 years, 10 years, 30 years. All these are the cash market where we can't really get into trading them or hedging them. And there's always futures available that we can see here, the 2 years, 5 years, 10 and 30 years futures. And what I'm going to do here is that since the yield seems like it's going to move up, and this is what I will be trading. And let's look at, and that's what we saw here. The March 2022, the market started to move up, the interest rate or the yield. And for a short-term play or the hedge, this is what I'm going to do. And I'm going to look at the daily chart, and I've saw this uptrend line. And what I'm going to do here is that I'm going to parallel it to get this trend. And we could see that it's almost approaching the support. I'll be definitely keen to get into the 10 years yield to hedge or to trade into this product. Now, what could be the other reason for the inverted yield? When the issuer or the government offer investor a much higher return on its shorter term bonds tenure. In my opinion, this also means that they need to keep up its short-term liquidity robust to keep all things running. The market are always telling us on their next move. Join us in our weekly case study and discussion. Click on my profile icon to find out more. Feel free to leave any comments below. I'd love to exchange ideas with you. Really happy that you stayed through this tutorial. You have many great trading weeks ahead.